to the cloud. Okay, there we go. We're talking about Form 22C, seller financing. And we're just talking about who's used one recently. Well, interest rates are really, really, really low. So why would a buyer ask for seller financing right now, right? That's a question you really need to find out, because the question is, why can't buyer get a loan? Now, we're hearing from our loan officers that credit is loan, interest rates are really great, but credit is gotten tighter. The requirements to get those low mortgage rates have gone up. But one of the things you need to know is if a buyer can't get a loan from a bank, probably the first question a seller is going to want to know is, why do they need a loan from me, right? And so I think it's important to look into that. And it's a form that you can do. I don't know if you remember the old Air Supply song. It was Making Love Out of Nothing at All. It's easy to use this form to make a buyer out of nothing at all. And so be careful, because it can be very concerning. Now, sometimes there's some reasons that make a lot of sense. If the buyer's asking for seller financing, they can't get a loan. Maybe they've started a new business, they're self-employed, and they need 2 years of tax returns in order to qualify for a loan, and they only have one. So they need seller financing so that they can operate their business one more year, so they have 2 years of returns. So it's important to know that. By the way, we'll talk about this. When you're doing seller financing, buyers should be prepared to put enough down to cover seller's closing costs. So I've seen a couple recently where the buyer wanted to put 5% down, but the seller had a 6% commission to pay, and plus excise tax to the state of Washington, right? Plus the seller portion of insurance. So there's about 8.5% of the purchase price that the seller has to pay. And the buyer can't get a loan. They want the seller to finance the balance of the property, and they're not even putting enough down. The seller has to take money to closing. Not a lot of sellers are going to sign up for that. Right. And so just because a buyer wants to do one doesn't mean it's a good idea. So I think that's where, as a trusted advisor, we need to understand why. Now, let's go to the seller side. There are times when the seller wants to provide seller financing. That's the preferred method of selling. Why would that be the case? Well, maybe they want to sell and maintain and set up for themselves some monthly cash flow. So, for example, if I owned an income property and it was free and clear, and I sell it, but I want to hold seller financing terms, that's the way I want to sell it, then those payments could be structured over a period of time to continue to give me monthly cash flow. And I don't own the property anymore, but the debt is secured in the real estate until it's free and clear. So sometimes sellers want to provide financing. The other time that Jose Martinez recently used it, and the buyer was buying a home that would require a jumbo loan. Well, as you know, right now during the times we're going through, jumbo loans are harder to get. Some of them have gone away altogether. And so his buyer decided to get the maximum conforming loan amount that they could. And then the balance, the seller said, why don't I hold a second mortgage for the balance of the price? And that way you can proceed to purchase. So that would be another time when you could use this seller financing form. So this is a case where they're not going to the bank. They're going to ask the seller to hold financing. So that's the form. It's 22C. So I'm going to bring it up, and we'll look at it together. And so first of all, I want to remind you that with every form, that there is a little help guide, or manual. So this is the 22C manual. And I thought what we do is this first part explains the use of the first page, and then we jump to the form. So first of all, we need to know that one of the things that a buyer is going to check is that the home is going to be used as a residential dwelling. Well, usually that's the case. Whether it's an income property or they're going to live in it, it's a residential dwelling. So if it's a residential dwelling, then the seller needs to, there's some restrictions on the seller's ability to provide a loan to the buyer. And so, and they're outlined here. The seller needs to be a person, an estate, or a trust. Okay, so the seller can't be a loan originator. The seller must not have financed the sale of another property within the last 12 months. The seller must not have constructed or acted as the contractor for the construction of the residence on the property in the ordinary course of seller's business. So, builders can't sell their own properties by this method, right? They don't meet these criteria. The repayment schedule can't result in a negative amortization. Rosalie's been in the business long enough. Some of you have been in, can remember the negative amortization loans, right?
Yes.
There's a version even still today called a reverse mortgage. And so, the seller can't be doing that. Financing must have a fixed rate. If it is an adjustable rate, it's got to be at least for 5 years, okay? So it can't, and if there's increases to that adjustable rate, it has to be reasonable. They can't just have the situation. Remember those loans when we went into the last economic downturn, there were those loans where the teaser rate got people into a property they couldn't afford, but a year later when the adjustable rate kicked in, they couldn't afford the payments, and so they were in trouble. So there's some criteria. Now, the seller is supposed to get a waiver from the state. It's the Washington State DFI waiver that they meet all of those criteria. And, basically, it doesn't mean that it kills the deal if the seller doesn't provide that form, but the buyer has a right to terminate the agreement if they don't get one. So just know that's a process. The seller can go get this from the state, and, so it explains this in the form. So the other part that I wanted to make you aware of, throughout the form, they mention LPB forms. And a lot of times people say, well, where do you get those? Well, you see the blue link here? If you're in the manual for the Form 22C, you can find the link to access the LPB forms. And we're just supposed to attach a blank copy. So we'll tell you, like, specific to a note and deed of trust, it'll tell you which LPB form they want you to attach, but you just print it out and you just attach a blank copy. Okay. So the other part on the front of the page is it talks about attorney review, and they're advised to seek legal counsel, that transactions involving seller financing are complicated, require special expertise. So we encourage our clients to they don't have to, but we encourage it. However, you see mandatory attorney review. It says that if the parties are making changes to the addendum, they're wanting to strike language or get creative or rewrite it for any reason, then parties must have it reviewed by legal counsel. That's to protect you and I and our parties, because it can get complicated. If they want to amend our attorney-approved forms in any way, then they have to go have it approved by an attorney. So page 1, that's what that covers. And so what I'm going to do is I'm going to jump to the form itself now, and we'll take a look here, and then this has 7 pages. So one of your assignments, if you really want to learn this form, is to look up the manual and go through that form. Okay. So now let me bring up the form itself. Oh, whoops, sorry. I brought up the same one. Let me get you the actual 22C addendum. Okay, we just covered the first page, basically, okay? Now, with the exception of the bottom, this is where we start filling in blanks. And so at the bottom there, 22A, that's where we just put, and this should mirror what's on the purchase and sale agreement. How much earnest money is there? Now you can also put what's the additional money that the buyer's placing down, so that you have the total down payment, right? So earnest money plus the down payment is total down, which would mean the balance of the purchase price would be the amount you're asking the seller to carry or to provide a loan for, okay? So you do that right at the bottom of page 1. So page 2 allows you to put in the interest rate, okay? And, you know, usually it accrues on closing. If you don't check a box, that's when it is. Now, one of the things to keep in mind, if you represent a seller and somebody's bringing this, um, there's a reason why the buyer can't go get a loan right now. And usually it's because of the lack of credit or some other reason. A seller, why would a seller take more risk than the bank would take? So often the interest rate that a seller charges is higher than the buyer could go get from the bank. And you could say, hey, buyer, you know, if you want that interest rate, go to the bank. If you're wanting me to take on the risk, I think interest rate should be, and it should be more. Maybe it's a 1% more instead of 3.5% or 3.25% right now. Maybe it's 4% or 4.5%. It typically should be a little bit more. And if you're representing the buyer, prepare them for that, because a buyer will go, hey, you know what? I want the seller to take financing. I can't get a loan right now, but I hear interest rates are really low. I'd like a 3% interest rate. And what you might do is set up some expectation that if the only place you can find a loan is from the seller, you should be prepared to offer a little bit more interest than because, you know, you have to go through a lot of hoops to get that loan from the bank. And so, you know, so then you can check what kind of payments. Are there installment payments? Usually there are principal and interest installment payments of blank. And you can put, they're usually due monthly, due on the first or fifth day of the month. So you can fill in those blanks there under payments to the seller. By the way, if you need help knowing what the amount is, you know the amount of the loan, you know the interest rate. Based on the amortization schedule, if it's a 15-year or 30-year, you can go online and pull up any mortgage calculator, and you can actually print out what the payments are for a 30-year loan or for a 15-year loan. And so you actually can find that, and you can put in that amount. And so sometimes you can put that in, you can put an asterisk, and when it's final calculation, it may be subject to change, but you can put in that amount from using a mortgage calculator. You can find online, or you can ask your lender you usually work with to look that up for you. So you can check. So then what is most common, most of the time you're going to check, this is going to be a promissory note and deed of trust. This is what banks use, as opposed to if you check promissory note and deed of trust, on the next page, it goes to real estate contract. You won't be checking a real estate contract. You'll be checking one or the other. It's either a note and deed of trust, or you're asking the seller to hold a contract. Okay, so what's the difference? The note and deed of trust, the property closes into the buyer's name. And of course, the note and deed is the security that's recorded against the property to give your seller the security in that property until they're paid in full, right? Just like with a bank. The bank has a note and deed of trust. Once you've paid the bank off, then it's paid in full and they release the note and deed of trust. So it's the security instrument. The difference with the real estate contract is that the property stays in the seller's name until the contract is satisfied. Now, a lot of buyers don't like that. Why would a seller want to do a real estate contract? Well, if you talk to attorneys, they'll tell you that the ability to foreclose on a property is slightly easier and can be done more quickly than with a note and deed of trust. But in both cases, a seller can take back their property for buyer default. They can do it with a note and deed of trust. They can do it with a real estate contract. Most buyer's attorneys will recommend that they do note and deed of trust because it closes into the buyer's name. It's kind of what most buyers are used to. And it's still, with default, the seller is still protected. So now note here, though, is that if the property is primarily for agricultural purposes, then a non-judicial foreclosure remedy is available only by using a real estate contract. If your clients are not sure which one they want to do, you refer them to legal counsel. That becomes a legal question. We can't answer that. But from a practical standpoint, the main difference is note and deed of trust is what is most commonly used, and the property closes into the client's name. So if we go back to the page and they've checked promissory note and deed of trust on page 2, you can kind of go down some other boxes. The one you're going to want to check is deed of trust. The paragraph 3 item B. It's LPB Form 22A. That's the deed of trust with a due on sale clause. Any loan you get from a bank, there's a due on sale clause, meaning that if you sell the property, the lender has to be paid in full out of the proceeds of the sale. You can't wrap that loan to another buyer. So that's possible, and 22A can be checked, but it's not, again, in your seller's interest to do that. And most buyers, you know, any loan they would get, there's a due on sale clause, meaning if I sell this home before I've paid the seller in full, out of the proceeds of the sale, the balance of the mortgage has to be paid. So you want to check B. Note that it says there that there is an LPB Form 22A. When you use that link that we just saw on the related form, you can find LPB Form 22A. You can print it out, and you include a blank copy of that with these forms. And the title company can work on preparing the actual note and deed. And of course, with the attorney review, parties are allowed to take that if they want to review it prior to closing and do that. But your job is to just attach the blank form, and it's available from that link provided in the manual that we initially saw. Here's the default interest, like any loan, and it's 18% if not filled in if you miss a payment. There's late charges. Those are typical for banking. And so certainly your buyer needs to be aware of those. They could ask for the penalties not to be as extreme, but remember, if a seller's going to make a loan for a buyer because the buyer can't go to the bank, there's additional risk. And so these are standard type penalties the buyer could expect if they went to a bank. So that's where you can put that in. They also, an important box to check, if the buyer hasn't, then for your on behalf of your seller, no further encumbrances. Make sure that until the buyer has paid off the loan in full, they don't further encumber the property with more loans, like second mortgages, putting up the property for additional collateral for other loans. And so with that, the buyer would say, okay, seller, I'm not going to take any other loans against my property until you're paid off. So that's what that allows you to do. Okay, so again, if you check note and deed of trust, you're not going to check real estate contract, and the rest has to do with something I've never seen done. It used to be done. If you won't even need to fill out any part of this, if it's about assuming an underlying obligation. So if the buyer's going to assume a loan, now there's some FHA loans that are assumable, so it can be done. If the buyer's going to assume a loan that already exists, then they can check the box and what is the amount of that loan, right? And there's consents to those underlying obligations. There can be seller wraps of existing loans. This was done way back when interest rates got to 18% in the 80s, a long time ago. And maybe at that point, a seller had a loan that was for a lot less interest, and they would find a way to wrap the existing loan into the buyer's new loan to save them on interest. These aren't done very much. You're not going to need to use any of these, but this is one to just make a note. See me if this comes up, but you rarely need to use this page at all if you've checked note and deed of trust on the other page. So this page is still there, but you don't really need to fill out anything here. Now we're on to the last page. The top is a continuation of the previous. You don't really need to, you're not assuming or wrapping. You don't need to use any of that section. So let's look at the last part you would need to pay attention to, and that's the other terms. So it's really important, I think, to have a third party act and hold a collection account. You know, if the seller's getting principal and interest payments each month, each payment, it changes slightly as to how much applies to principal, how much applies to interest. It's important, I think, to have a professional collection agency. Baker Boyer Bank does it. I know Columbia Title used to offer this service, where the parties agree at closing to set up a collection account, and that collection account would receive the payments from the buyer, do the appropriate accounting, and release the appropriate payments to the seller. This is especially helpful if you decide to sell the home before the loan is paid off, and there's a due on sale clause, so you would know exactly what the payoff amount is. The reason, when we all sell our homes and you have to get that payoff amount is it's constantly changing. And so a buyer and seller would have a hard time doing this. So I'm a big fan of having a professional do this when they are there's seller financing involved. So utilize a collection account, write in, Baker Boyer Bank can do it. You can find out any other number of services. Parties agree to split the cost of doing that, right? And so you can also ask them to manage the escrow, meaning that if this loan is paid in full, that the collection agency could set up the request for reconveyance and the fulfillment deed, stating that the loan is release of that deed in trust if they paid it off in full. One of the other ones that's really smart is, what about taxes and insurance? If a seller is going to hold a loan and you don't check this box, they're relying on the buyer who now owns the property to be paying their property taxes and insuring the property. Well, insurance is really important too, because that's the seller's security. So if you check this box, you're asking the collection account, just like it often is done when you have a mortgage with a bank, to collect the additional, as part of the monthly payment, collect the portion of the real estate taxes and the property insurance, liability insurance, so that they can make sure those are paid regularly and on a timely basis. There are sellers that have agreed to hold a mortgage, hold due seller financing to the buyer. The buyer failed to make their tax payments. The buyer failed to insure the property. Property burns down, and now the seller is really in a bad place, because they're securing the loan as the property, and it's burnt to the ground. So knowing that it's insured is really important, and you could check this box. If the tax liability gets really bad, the seller could get a notice that they're going to come in and ultimately they want to take over the property, right, or lien it with these huge tax liens. That would be bad for the seller until they're paid in full on their seller financing. So that is a really important, I believe, whenever possible, use 4A, and all of those things there are really important. B is great. It's saying, hey, the seller can review the buyer's finances. It allows if a bank is going to look at the buyer's, credit score and understand their financial capabilities, why wouldn't the seller want to know this? And so this would give the seller the ability to verify the buyer's credit score, buyer's income tax returns, verification of buyer's employment, all those kinds of things. I think it's really, really smart. By the way, if your buyer doesn't want the seller to do that, that's a bad sign. Because if a seller has a reason, a legitimate reason for wanting financing, and they want the seller to work with them on this, they should be willing to let the seller understand the buyer's situation and financial capabilities. The last one is sometimes used, and that's when the seller says, hey, you know what, I'm providing financing. Maybe the buyer isn't putting a lot down, and the seller has to pay all their closing costs out of the buyer's down payment. So the buyer says, hey, you know what, I'll pay your title insurance policy. So usually that's the portion the seller would pay, and the buyer says, you know what, I'll pay that for you. Thanks for providing seller financing. I'll pay those additional closing costs instead of you needing to. That is rarely checked, but it can be, and so that's what that box is about. Okay, let's jump off of that. That was it in a nutshell. Let's jump off of that. Any questions on Form 22C? So one of the things, I'm not hearing any. I see Diane on the call. Hi, Diane. Diane just did one of these. One of the things, Diane's a great example. If you fill one of these out, this will help you fill it out. If you fill one of these out and you, prior to proceeding for your clients to sign it, let me see it. And Mindy's on this call. She's gotten very, very good with all of these forums. This is one we all don't work with that much. So Mindy jumped on to kind of get better acquainted with it too. But the idea is let Mindy or I see this form, and just to help you answer questions and kind of talk through. And Diane and I did that, which was really great. She said, Doug, she emailed it to me. Here's what it looks like. So we got on the phone and we just went through the forum like we just all did together, and said, okay, let's go through this. I was able to ask some questions. We didn't have to change much. Diane did a great job. But then she had a higher level of confidence now, having her buyer sign it and actual present it. So that's it in a nutshell. So thanks for being on this edition of Forums Friday.